Capital gains tax is a tax that's charged on the profit that you make when you dispose of an asset that has increased in value. As I mentioned in my video all about CGT rules for individuals, it's the gain you make that's taxed, not the amount of money you receive. And some assets are not liable to capital gains tax. Those that are called chargeable assets. Every individual has a capital gains tax-free allowance, which is currently £12,300 each tax year. This means you can make a profit from the sale of certain assets up to £12,300 a year without paying any capital gains tax. It's important to know that you may be able to reduce your tax bill by deducting losses made in the same tax year or in previous years. If you make a loss on a chargeable asset when you dispose of it, you can report this loss to HMRC to reduce your total taxable gains. Losses used in this way are called allowable losses. So let me explain how it works. When you report a loss, the amount is deducted from the gains you made in the same tax year. If your total taxable gain is still above the tax-free allowance, which is £12,300 for the 22-23 tax year, and it's going to remain frozen at that level until 2026, you can deduct unused losses from previous tax years. If they reduce your gain to the tax-free allowance, you can carry forward the remaining losses to a future tax year. Claim for your loss by including it in your tax return. If you've never made a gain and not registered for self-assessment, you can write to HMRC instead. You do not have to report losses straight away. You can claim up to 4 years after the end of the tax year that you disposed of the asset. There's an exception for losses made before April 96, which you can still claim for. You must deduct these after any more recent losses. There are some limitations on claiming losses when you dispose of assets to your family and close contacts. You usually do not pay capital gains tax on assets you give or sell to your spouse or civil partner, so it follows logically that you cannot claim losses against these assets. You also cannot deduct a loss from giving, selling or disposing of an asset to a family member unless you're offsetting a gain from the same person. This also applies to connected people, which HMRC defines as including your brothers, sisters, parents, grandparents, children and grandchildren, and their husbands, wives or civil partners. It also includes the brothers, sisters, parents, grandparents, children and grandchildren of your husband, wife or civil partner, and their husbands, wives or civil partners. It includes business partners, company that you control, and trustees where you're the settler. You can claim losses on assets that you still own if they become worthless or of negligible value. HMRC has guidance on how to make a negligible value claim, which relates mainly to shares in trading companies, and you'll find a link in the description below. To find out more about what constitutes a chargeable asset and how much capital gains tax you must pay, follow the on-screen link now or check out the description below. Thank you so much for checking out my YouTube channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help people live successful lives. In my experience, that often involves understanding your money. I also have a podcast called the Retirement Cafe Podcast you might like to tune into. Check out the description below. If you've enjoyed this video, and I hope you have, please press the like button to help more people like you find my channel. For now, I'm Justin King, helping you live your best life.